Hi, welcome to another edition of This Week in Real Estate for February the 14th, 2024. We're going to go after what I would call the dead cat bounce, but we'll get to that a little bit later in the presentation. For the first part, let's take a look at some of the economic factors that under the numbers that came up this past week. So we take a look at some of the U.S. CPI and inflation data. And the inflation reports and the CPI are indicating that there are a number of declining factors. However, from last week, what we saw is what's going on between rate, Feds, CPI, all of those numbers between our two countries. And what we saw was the almost going steady relationship between the US Fed and the Bank of Canada. And a lot of times we can feel that it's kind of two steps forward, one step back. While the news that everyone may be feeling is a little bit deflated, we struggle to get some good news. And good news, one, that while CPI kind of bounced up a bit, the positive step for the future rate reductions is that, it's actually not so bad. We're seeing that it is kind of sticky, but the good news is that the Fed, alongside Tiff Macklin, is holding short on raising anything in terms of rates. Getting back to what I talked about last week in terms of that we are basically in lockstep with the US Fed. We are kind of going steady, US and Canada. And despite the fact that we've now got this world of Instagram, instant messaging, Amazon Prime, same day deliveries, we really just need to be a little bit more patient and see how, while they are painful, the interest rates raised will actually wind up working. And so with that, we can move on to sort of Canadian retail. And those numbers came out this week. And if we take a look at sort of supply versus demand editorial, and we take a look at what that means, and we translate from a retail perspective to a real estate perspective, that supply and demand also occurs in the retail environment. So in this, we're seeing a little bit of a pullback. And if we start taking a look at the frugality of what's going on within households, this will lead us to understanding that the retail sales pullback is because all of those owners are also feeling the pinch from higher mortgages. And if we take a look and dig a little bit deeper into the retail sales activity, January is definitely going to be a typical lower month. Honey, the credit card bill just came in. So what are we going to do? So take a look at it. It's downsizing. But if you dig a little bit deeper and see where the January 22 mark is, where you see the mark for January 23, we're actually seeing that the results for this year in January 2024 are actually a little bit less dramatic. So this chicken little sky is falling, a mentality of like everybody is pulling back, everything is tightening down, is not necessarily always the case. So next slide, we have, are Canadians feeling the pinch? Yeah. Did their discretionary spending go down? Yeah. Did the purchase of discretionary goods go down? Yeah. So are we going out? Are we dining in? Are we spending money on, more goodies? No, but that's typical. It's just after the holidays. It's after Christmas. It's after Hanukkah. They're all of the gifting season. And so that's normal. It's just to be expected. So what else is going to happen? Well, from that discretionary spending, instead of taking a trip, what are they going to do? Or going out and dining out. So you saw in the previous slide that we talked about, the reduction in services spending. Well, from the tripping department, consumers are spending and planning fewer trips and opting to stay at home. So you can see that the trend line on food and services from a projection perspective, the data isn't in quite yet, but this is what RBC is suggesting. And then this is also from what StatsCan is feeding as well. We can see that there's a downward trend. Fewer nights at hotels, lower air travel plans, core inflationary pressures are continuing to take hold of the daily consumer budgeting. And perhaps the cost of this travel and entertainment as part of our discretionary consumer spending and lines of increases on our credit card statements, that's prompted a little awakening, a little wake-up call for the consumer to sort of say, you know what, these discretionary spends I can make an easy cut and I don't have to worry so much about. So let's go get some popcorn and let's curl up on the sofa and watch a little bit of Netflix. So why not? And that's not a bad way to spend the winter. Now, we also talked about housing supply last week. And so here's some further information because of the recent news lines about supply, that the extraordinary demand that we were seeing on the housing market, not only for those that couldn't necessarily afford to get in and purchase, but those who are going into leasing or renting. That's a huge part of the real estate market. It's a gigantic section for a lot of realtors in the Toronto area to do an awful lot of leases. Well, we saw an incredible increase in demand for rental housing, especially for students. So with the foreign student reduction in caps, what is that going to do for the rental market? And this is one of the things that what the RBC Economics is forecasting is that finally maybe something will start to moderate, and that their forecast for 2024 is a significant reduction in the amount of students that are going to be coming in, and a slight easing, let's say, on the pressure of what's going on within the rental market. So does that mean that rental dollars will pull back? Probably unlikely, because we're going to start seeing a number of people be able to move into the market, and it will probably be a good 6 months before we'll be able to see things as these new units come online. And maybe we'll start to see a little bit of stability in the rental market versus incredible increases in those rental prices. Maybe it'll be and showing a little bit of a balanced market. Now, moving on to our dead cat bounce. So what I was getting onto here is that the January price increase may not really be a true predictor of a pent-up or a future exuberant spring market. What we're tending to see is that the price didn't increase, and then the seasonally adjusted prices are actually lower. So year over year and seasonally adjusted, that's kind of what's going on. And then recently, what came up in the news of what was brought to my attention was, the pent-up offers in terms of the number of offers on a property. So what was it? It was 3479 Longleaf Crescent. There it is, out in Mr. and Mississauga. So with that property, there were 85 offers. It got and garnered a tremendous amount of press and news. Well, the reality is that 85 offers on one specific property is not an indication of a really healthy market. It just is that the listing agent and the seller chose to list it below and significantly below the market value. So the listing agent actually reported that the number of offers that came in, that approximately 80% of those offers were well below the market value, and that the final price for the property was within the expectations of the owners and the listing agent. So the real truth of the matter is that it is indicative of the appeal of real estate as an investment, as something to own, whether or not it's going to be for their personal needs or for personal investment. The real challenge here with headlines that talk about 85 offers is the gimmickry that often realtors are pilloried for, and listing it super, super low. And those agents that are not necessarily managing the expectations of their clients that are going to be offering on the property. Again, what I'm getting at is that it's not really something to be super, super excited about. While it is see that we're seeing an increase in sales and the volume of sales within the marketplace, I'm just going to wait and see. So what happened in Toronto for the past few weeks in terms of freehold pricing? And we can see that there's a nice upward trend. And then we can also see what's kind of counterintuitive is that the months of inventory also slightly increased. But one of the things that you really have to take a look at here when focusing in on the Toronto area is that we're seeing a nice little trending price increase. And the key consideration is that it's only 2.04 months of inventory, which means that Toronto is still in a seller's market. The idea that this is a buyer's market is not the case. The months of inventory for freehold may have increased in the last, 8 months from a really ridiculously low amount of 1.26 months of inventory. That the Toronto prices in terms of their pullback, May last year was 1.78 million is what my numbers came up with. And given the interest rate increases, the days on the market, the Toronto freehold market is still very healthy, and it's not in a free fall. It will be a bit of a maybe keep you up at night or something like that if you just purchased last year or within the past couple of years, that those decrease in prices may have you losing a little bit of sleep. The truth of the matter is that Toronto is still a very, very healthy market. So take a look at the trend for what was sold last week, and that was that there's a nice upward trend average on those homes that have been sold. In terms of the days on the market, those are steadily decreasing, and we see that in the following average trend in terms of what's going on in Toronto. So these are all good indicators, given the fact that we had a very sluggish fall in December. Well, what's going on in the Toronto condo market? Well, the Toronto condo market, in terms of its pricing, it actually remains really healthy. While the prices may have come off slightly, last May the average I ran hit about 801,000 in terms of the condos. And that's hovering now, as we can see with this number, at about 749K, 750K, representing about a 6.5% decline in pricing. And the inventory, oh my God, we take a look at the inventory and it's 3.24. So what does that say? That still is indicative of a seller's market. However, it's double what it was in May of 2023. But with that doubling in terms of the number of months of inventory, we are not seeing a proportionately big decline in terms of condo prices. Remember, Condos are really the first rung on the property ladder. They're loved by a lot of small investors. They're loved by downsizing families, and they're loved by those who want to get into the real estate market. And that's what's keeping this market and the Toronto condo market reasonably healthy. And we take a look at the number of the condos sold in terms of last week. It was 288 condos sold. Again, the moving average indicator here in the graph is suggesting a slight little pullback. But the nicer one to see is that the days on market are coming back in much better. So for sellers, you know, it certainly was off the high mark of 410 units that were sold last May, and the days on the market of 32 is really about 40% higher than most condos. But the thing is, if you were already on the property ladder, those owners are benefiting from a really stable pricing given all of the other market conditions. The only downside for the seller is their condo might take a little bit longer to sell. The prices have pulled back slightly, but again, those who are in the market and stayed on the market were in great shape. And so that's it. Hope that gives you a good little snapshot of what happened in Toronto real estate this week, and look forward to speaking with you guys next week.